So, back in 1955, the bond market did something, wow, something really weird.
Extremely weird.
Right, a very specific line on a graph just kind of flipped upside down. And shortly after that happened, the U.S. economy crashed.
Like clockwork.
Exactly. And since then, every single time that line flips, a recession follows. So today, we're going to decode this thing, the most feared, most accurate financial crystal ball in existence, the yield curve.
It really is the ultimate diagnostic tool. And, while it might sound like this super abstract concept reserved for, institutional trading floors, it's actually the physical footprint of trillions of dollars moving in anticipation of the future.
Wow. Trillions.
Yeah, literally trillions. So understanding is just non-negotiable if you want to know how the global economy truly operates.
Which is exactly why we're dedicating this entire deep dive to you today. Specifically to those of you who are staring down the barrel of the Series 65 exam.
Oh, yeah, the Series 65. This topic notoriously acts as the ultimate gatekeeper for that test.
It really does. But hey, even if you aren't prepping for an exam, if you are just someone who wants to understand the foundational bedrock in the financial markets, this is totally for you.
Absolutely.
We are working from a highly concentrated source today. It's a Series 65 yield curve cheat sheet from Economics and Fixed Income, published in May 2026.
A very dense but incredibly crucial document.
Super dense.
Yeah.
And our goal here isn't just to help you memorize a few bullet points.
Right.
Because if we just tell you what happens, you will definitely forget it under the pressure of the exam.
Right. Memorization will absolutely fail you here.
Exactly. Instead, we're going to explain the fundamental mechanics, the why and the how behind every single rule. If you can internalize the underlying physics of how these financial levers work, you won't need to memorize anything.
You'll just instinctively know the answer.
Exactly. You'll just know it.
And really, that is the only way to approach this material successfully. The exam is specifically designed to punish people who just memorize flashcards.
Oh, they love doing that.
They really do. They will layer 3 or 4 concepts into a single question just to see if your understanding breaks down. So we need to build a mental framework for you that is completely bulletproof.
Okay, let's unpack this. Before we get into the Federal Reserve pulling levers or, how your equity portfolio is going to react, we have to establish what this curve actually looks like in its natural habitat.
Right, the baseline.
Yeah. So we're talking about a standard graph here. On the bottom axis, you have time. It starts at 0 years on the left and stretches all the way out to 30 years on the right.
Just think of that as the lifespan of a loan.
Exactly. And then on the vertical axis, you have the yield, or the interest rate, represented as a percentage. So time on the bottom, yield on the side. The cheat sheet isolates 3 fundamental shapes this curve can take. Let's start with the first one, the normal curve.
Okay, so in a normal curve, the line starts low on the left side, which represents short-term yields, and then it gradually slopes upward and to the right, which represents higher long-term yields.
Okay, so give me an example of that.
Well, say a 3-month Treasury bill might pay a 1% yield, but a 30-year Treasury bond pays 4%.
Got it.
That upward slope is basically the mathematical visualization of a healthy, growing economy with moderate expected inflation.
Wait, let's pause there and really dig into the mechanics of why an upward slope is considered normal. Why do investors universally demand a higher yield for a 30-year bond compared to a 3-month bond?
That's a great question.
Because it feels like common sense, right? But I know the exam demands the technical terminology behind that common sense, and the cheat sheet isolates this concept called the term premium.
Yes. The term premium is the extra compensation an investor strictly demands to take on the compounding risks of time.
Compounding risks.
Right. When you lend your money to the government or to a corporation, for 30 years, you are stepping into a massive unknown. You are basically taking on 3 specific risks.
Okay, what's the first one?
The first, and honestly arguably the most destructive, is inflation risk. I mean, if inflation averages 3% a year for the next 3 decades, the purchasing power of the money you get back at the very end of the bond's life will be a fraction of what it is today.
Oh, wow. Yeah, it just gets eaten away.
Exactly. So you demand a higher yield up front to act as a shield against that future inflation.
Okay, so that's inflation risk. And the second risk is credit risk, right?
Right.
Because even if we were talking about highly rated corporate bonds, 30 years is just an absolute eternity in the business world. Companies that looked invincible in the 1990s are completely bankrupt today.
Blockbuster is a great example.
Yes.
Yeah.
Blockbuster. So the longer the timeline, the higher the mathematical probability that the borrower might experience some sort of catastrophic failure and default on a loan.
Precisely. And then the third risk is simply the generalized uncertainty of time itself. To visualize this, consider how a bank approaches a mortgage. If you walk into a bank and ask for a one-year loan to buy a small property, the bank has a very clear picture of the immediate future.
Sure, they can see a year out pretty easily.
Exactly. They know what current inflation looks like. They know your current employment status is likely stable for the next 12 months, and they know the broader economic weather. So they might offer you a very low interest rate.
But if I ask for a 30-year fixed-rate mortgage, the dynamic completely changes. The bank has absolutely no idea what the global economy will look like in 3 decades.
No one does.
Right. We could have technological revolution, a massive geopolitical conflict, or, hyperinflation. Because they are taking a massive blind gamble in the next 30 years, they demand a higher baseline interest rate just to protect themselves.
Exactly.
So that extra percentage they charge me, that is the term premium in action.
That is a perfect translation of the concept. The term premium strictly compensates for the risk of the unknown. But, there is another psychological layer that physically pushes that long end of the curve higher.
Okay, what's that?
The cheat sheet defines it as liquidity preference.
Liquidity preference.
Right. Human beings, and by extension institutional fund managers, have a natural bias toward keeping their capital liquid. We want our money accessible in case a sudden emergency arises, or maybe a brilliant new investment opportunity appears tomorrow.
Right, like an analogy would be renting a car for a day versus signing a 10-year lease with no exit clause.
That's a great way to think about it. A 3-month bond is highly liquid. You park your cash, you get a little interest, and you get your principal back almost immediately. You remain agile.
Agile. I like that.
But a 30-year bond essentially ties your hands behind your back. If you want me to give up my agility, you have to bribe me.
And that bribe is called the illiquidity premium.
Yes. And as our material explicitly notes, the illiquidity premium stacks directly on top of the inflation premium.
Oh, they stack.
They do. Those two premiums combined create the invisible gravitational force that pulls the right side of the curve upward. So when you see that upward slope, you know the market is functioning normally, investors are being properly compensated for risk, and the Federal Reserve is likely operating with a neutral or slightly accommodative policy.
They are just letting the healthy economic engine run.
Exactly.
But economies are cyclical. They don't stay in a perfect state of healthy growth forever.
Yeah.
The friction changes. And that brings us to the second face of the curve, the flat curve.
Right.
So on our graph, this is just a perfectly horizontal line. It sits at, say, 3% yield all the way across. A 1-month bond yields 3%, and a 30-year bond yields exactly the same 3%.
The moment you see a flat curve, you have to recognize that the fundamental logic of the market has essentially broken down.
How so?
Well, the term premium we just spent time dissecting has essentially vanished. Investors are suddenly willing to lock their money away for 30 years without demanding any extra compensation for inflation or time risk.
Which really begs the question, why? Why would institutional investors suddenly abandon the basic principles of risk compensation?
Because a flat curve represents a state of profound transition and deep economic uncertainty.
Transition.
Right. It is the microsecond where the pendulum is suspended perfectly straight down in the middle before it continues its arc. The market is completely undecided.
So the data coming in is just conflicting.
Exactly. Perhaps inflation is ticking up slightly, but unemployment is also rising. Investors are looking at the landscape and saying, we have absolutely no idea if we are heading into a period of prolonged growth or if the bottom is just about to fall out.
It's like a diagnostic loop of uncertainty. Because if the market is relying on the yield curve for signals, but the yield curve itself is flat and signaling total uncertainty, it creates a very tense environment.
Extremely tense.
And the cheat sheet notes that during a flat curve, the Federal Reserve is usually at a pivot. They're transitioning, they have paused their policy, they're waiting for the smoke to clear before they make their next move.
And a flat curve rarely lasts long. The tension is just too high. Eventually, the economic data forces a resolution. The pendulum has to swing.
And when it swings toward contraction, we arrive at the third shape, the anomaly. The shape that triggers alarm bells across every single trading desk in the world. The inverted curve.
Yes, the dreaded inverted curve.
This is the exact opposite of the normal curve. The line starts incredibly high on the left side, so maybe 5% yield for short-term bonds, and then it slopes downward, sinking to perhaps 2% at the 30-year mark.
It's totally
Right.
backwards.
You're getting paid significantly more to lend your money for 3 months than you are for 30 years. It completely defies the gravity of the term premium.
It defies it because panic has entirely overridden standard risk models. This is the shape connected to the 1955 statistic we mentioned at the very beginning of the deep dive.
Oh, right. Let's bring that back.
Yeah.
Because our source material highlights this as exam tip number 1, and it phrases it as an absolute rule.
Yes, it says the inverted curve is the most reliable leading indicator of a recession, having preceded every U.S. recession since 1955.
Every single one. That's wild. And the tip literally says it is always the answer for recession prediction questions.
Always. If the exam asks you what predicts a recession, you look for the word inverted and you click it.
But we promise to explain the mechanics. Why does this bizarre downward sloping shape guarantee a recession? Like, how does it actually form in the real world? The cheat sheet introduces expectations theory to explain this.
Yes.
It states that long-term rates reflect market expectations of future short rates.
What's fascinating here is that to understand expectations theory, we have to look at the catalyst. An inverted curve doesn't just happen by accident. It happens because the Federal Reserve is engaged in aggressive tightening.
Aggressive tightening, okay.
Right. They are intentionally jacking up short-term interest rates to fight off severe inflation. They are slamming on the brakes of the economy to cool things down. So the short end of our curve gets forced up to 5 or 6%.
Wait, hold on. If the Fed knows that aggressively hiking rates causes an inverted curve, and they know an inverted curve historically guarantees a recession, why do they do it? Are they purposefully trying to crash the economy?
I mean, that seems entirely counterproductive to their mandate, right?
Yeah, exactly.
Well, that's the ultimate central banking dilemma. The Fed operates under a dual mandate: maximize employment and stabilize prices.
Okay.
When inflation spirals out of control, prices destabilize. And unchecked inflation destroys the purchasing power of the middle and lower classes. It is economically corrosive.
It really is.
So the Fed views rampant, entrenched inflation as a far greater long-term danger than a temporary recession. So they hike rates, they make borrowing extremely expensive for businesses and consumers.
Right. Because by making money expensive, they choke off demand.
Exactly. When demand drops, prices stop rising. But choking off demand is literally the definition of inducing an economic slowdown.
So they're trying to thread a microscopic needle here, cooling inflation without causing a recession.
Yes. But history shows that blunt instruments usually cause blunt trauma.
So the Fed forces the short-term rates up to fight inflation. Now, let's bring the investors back into the picture to explain why the long end of the curve drops. The investors are watching the Fed aggressively hike rates.
Right, they see the brakes being slammed.
They are watching the economic demand get choked off. Applying expectations theory, the market collectively realizes the Fed is going too far. They're going to break something. A recession is inevitable in the next 12 to 18 months.
And if a recession is inevitable, what will the Fed be forced to do when the economy starts crashing?
They will have to panic and slash interest rates back down to zero to stimulate the economy again.
Exactly. So place yourself in the shoes of a portfolio manager running $10 billion.
Okay, I'm the manager.
You can get 5% today on a short-term bond, but you strongly believe that next year a recession will hit and rates will plummet back to 1%. If you keep your money in short-term bonds, next year you will be forced to reinvest at that miserable 1% rate. What is your alternative?
Well, I look past the immediate chaos.
Yeah.
I look out to the 10-year or 30-year bonds.
Yeah.
Even if those long bonds are currently only yielding 3%, which is lower than today's 5%, I want to buy them immediately.
Yes.
I want to lock in that 3% for the next decade, because when the recession hits and short rates drop to zero, my locked-in 3% is going to look incredibly valuable.
That foresight triggers a massive global stampede. Trillions of dollars rush into the long end of the bond market to lock in yields before the impending crash.
A stampede.
And here's where the mechanical physics of the market take over. When everyone rushes to buy long-term bonds, the intense demand drives the price of those bonds up.
Right.
And as we will discuss in extreme detail shortly, there is an unbreakable inverse relationship between a bond's price and its yield. Because the overwhelming demand forces the price of the 30-year bonds into the stratosphere, the yield on those 30-year bonds is crushed downward.
So the inversion, that downward slope, isn't just some theoretical model. It is the physical, mechanical result of the entire financial market bracing for impact.
Yeah.
The rush to safety physically forces the long-end yield down, while the Fed physically forces the short-end yield up. The curve inverts.
And that is exactly why it is the ultimate recession signal. It represents the collective conclusion of the smartest money in the world. They are voting with trillions of dollars that a crash is coming. If you understand that mechanism, you will never get a recession prediction question wrong.
Okay, so we have a really clear picture of the three shapes: normal, flat, and inverted. We also see how the Federal Reserve's actions act as the catalyst for these shapes.
Right.
But to truly master this material for the exam, we need to open up the Fed's toolbox and examine the specific levers they're pulling. Like, how exactly do they force short-term rates up or push long-term rates down? Our source material outlines 4 specific tools.
Think of the yield curve like a massive, heavy jump rope. The Federal Reserve is holding both ends of the rope, and they use different tools depending on which end of the rope they need to move.
Oh, I love that visual. A jump rope. Let's start with the tools they use to whip the short end of the jump rope up and down. The first tool is the Fed funds rate, which our cheat sheet defines as overnight bank lending.
This is the most crucial and honestly often most misunderstood interest rate in the global economy.
Really? Misunderstood how?
Well, the Fed funds rate is not the rate you get on your savings account, nor is the rate you pay on your credit card. It is the interest rate that commercial banks charge each other to borrow money on an overnight basis.
Wait, why do banks need to borrow money from each other just for one night?
Because of reserve requirements.
Well,
By law, banks are required to hold a certain percentage of their depositors' cash in reserve at the end of every business day. They can't just lend out every single penny.
okay. That makes sense.
Throughout the course of a normal day, millions of transactions occur. Some banks end the day with excess reserves, while other banks find themselves slightly short of the legal requirement.
So they just balance each other out.
Exactly. The bank with excess cash lends it to the bank with a deficit just overnight, so everyone meets their regulatory requirements. The interest rate charged on that microscopic overnight loan is the Fed funds rate.
It is the absolute shortest term interest rate physically possible. One single night.
Yes.
So when the Federal Reserve announces they are hiking rates, they are actually raising the target range for this specific overnight rate.
That's right.
By forcing banks to charge each other more to borrow money, the Fed increases the fundamental cost of capital at the most granular level. And that cost increases instantly cascades through the entire banking system, pushing up prime rates, auto loans, and short-term bond yields.
They flick the short end of the jump rope violently upward.
The second tool is intimately related, the discount rate. The cheat sheet simply notes this is charged to banks. So if banks are already borrowing from each other, using the Fed funds rate, where does the discount rate come in?
While the Fed funds rate is the open market rate between commercial banks, the discount rate is the interest rate the Federal Reserve itself charges banks that borrow directly from the Fed's own discount window.
Oh, directly from the Fed.
Yes. Generally, the Fed sets the discount rate slightly higher than the Fed funds rate.
Why higher?
They do this because they want banks to exhaust the open market first. Borrowing directly from the central bank discount window historically carries a slight stigma. It suggests a bank couldn't find a willing partner in the open market.
Like a last resort.
Exactly. But from a mechanical perspective, moving the discount rate is just another way the Fed directly manipulates the extreme short end of the yield curve.
Yeah, so those are the short end levers. But what if the Fed wants to shift the entire curve up or down simultaneously? That brings us to tool number 3, open market operations, or FOMO. The text defines this as buy-sell treasuries.
Open market operations are the daily bread and butter of the Fed's monetary policy. The Federal Reserve maintains a massive balance sheet, holding trillions of dollars in government bonds.
Yeah.
If they want to gently raise interest rates across the broader curve, they sell some of their treasuries into the open market. When commercial banks buy those treasuries, cash leaves the banking system and goes straight into the Fed's vaults.
So they are pulling money out of the system.
Right. By draining cash out of the system, money becomes more scarce. When something is scarce, its price, which in this case is the interest rate, goes up.
And if they want to lower rates, they just run the operation in reverse.
Exactly. They buy treasuries from the banks, depositing fresh, newly created digital cash into the bank's reserve accounts. The banking system is suddenly flush with liquidity. Money is abundant, so the price to borrow it, the interest rate goes down.
So it's a constant daily mechanism of draining and adding liquidity.
Yep. But sometimes standard open market operations aren't enough.
Like during a crash.
Right. During severe crises, like the Great Financial Crisis or the pandemic, the Fed will drop the short end of the jump rope all the way to zero, but the long end of the curve, the 10 and 30-year yields, might remain stubbornly high because investors are terrified of the future.
So they need a bigger tool.
They do. The Fed needs to drag that long end down to make long-term borrowing cheap so corporations will build factories and hire workers. That requires the heavy machinery. Tool number 4, quantitative easing, or QE.
Our cheat sheet defines quantitative easing very specifically. By long bonds to push down long-end yields. We touched on this earlier when discussing the rush to safety during an inversion, but we need to isolate the Fed's role here.
It's critical to understand.
How does the Fed buying long bonds physically force the yields down?
Well, it relies entirely on the inverse relationship between price and yield. During quantitative easing, the Fed announces they are going to buy billions of dollars of long-term bonds every single month.
Just massive purchases.
Massive. They step into the market as a totally price-insensitive buyer. They don't care about getting a good deal. They only care about executing the policy. This creates an overwhelming artificial demand for long bonds.
And massive demand forces the price of those bonds to skyrocket.
Exactly. And because of the mathematical laws of fixed income, as the price of those long bonds surges upward, the yield they offer is crushed downward.
So quantitative easing is basically the Fed throwing its entire institutional weight onto the far end of the jump rope, pinning it to the floor. They are artificially suppressing the term premium to force the economy back to life.
That's a great way to summarize it. When you see a question about the Fed manipulating the long end of the curve, the answer is almost always quantitative easing.
Okay, we have covered an immense amount of ground. We understand the shapes, we understand what they signal, and we understand the exact tools the Federal Reserve uses to bend the jump rope.
The foundation is set.
But now we have to make the crucial pivot. We have to look at how these massive macroeconomic forces affect the specific investments sitting in a client's portfolio. Because this is the transition from economic theory to actual financial advising, and, well, it is where the Series 65 exam sets its most vicious traps.
Oh, absolutely. If you don't have the fundamental laws of bond mechanics internalized, the exam will tear your logic apart. You have to understand how a single bond reacts when the Fed pulls those levers.
Which brings us to the golden rules. I'm looking at exam tip number 2 on our cheat sheet. It is arguably the most important sentence in the entire document. Price yield inverse bond prices, and yields always move opposite directions. Rates rise equals prices fall. Never get this wrong.
Yeah, the authors of the guide didn't use all caps for always lightly.
Never get this wrong.
Exactly. There are very few absolute certainties in finance, but the inverse relationship between bond prices and bond yields is an unbreakable law of financial physics.
I want to give you a mental model that you can rely on when the exam pressure hits.
Yeah.
Picture a physical playground seesaw. A rigid wooden plank balanced on a center pivot point.
Okay.
On the left seat of the seesaw, paint the word yield or rate. On the right seat, paint the word price. Because it is a rigid piece of wood, it is physically impossible for both seats to go up at the same time or down at the same time.
Right.
So if the Federal Reserve hikes interest rates, forcing the rate side of the seesaw high into the air, the price side is violently slammed down into the dirt.
And conversely, if the Fed slashes rates, pushing the rate side down, the price side launches up into the sky.
So simple.
It is. If you are taking the exam and a question states, interest rates are rising, you must immediately reflexively cross out any multiple choice answer that suggests the price of existing bonds is going up. The seesaw makes it impossible.
But the exam won't stop there. They won't just ask if prices go up or down. They will ask which specific bonds fall the hardest. They want to know if you understand the magnitude of the impact. And that introduces the concept of duration risk.
Yes. Duration risk is highlighted in multiple places on the cheat sheet. Under key concepts, it defines duration risk simply: longer maturity bonds, more sensitive to rate changes.
Okay, more sensitive.
Then, in exam tip number 3, it provides the explicit mathematical rule. Longer maturity equals greater price change per 1% rate move. It even gives a devastating example. A 10-year duration bond loses approximately 10% when rates rise 1%.
Let's expand on the seesaw analogy to explain the physics of duration risk. Why does a longer maturity mean a more violent price swing?
It's all about leverage.
Right. Imagine that same seesaw. If you have a short-term bond, say a one-month treasury bill, that bond is sitting right next to the center pivot point. It has very low duration.
So if the seesaw tilts, that middle section only moves an inch or two up or down.
Exactly. The short maturity protects it from the full swing of the rate change.
The exposure time is so short that the prevailing interest rate environment barely has time to affect it. It matures, and you get your money back before the environment can shift drastically.
But a 30-year bond is sitting on the very, very, very edge of the seesaw's farthest seat. It has a massive lever arm. When the rate side moves even a tiny bit, the extreme edge of that lever travels a massive distance.
That's a perfect visualization.
When rates shift 1%, that 30-year bond gets launched into orbit or slammed into the ground.
And the math provided in the text highlights how destructive this can be. If you hold a 10-year duration bond, and the Fed hikes rates by just 1%, which is typically just 4 standard quarter-point rate hikes over the course of a year, your bond loses 10% of its capital value.
10%.
Yes. In the fixed income world, where investors are looking for safe, steady returns, a 10% principal loss is catastrophic. That is the true danger of duration risk.
And the exam will test your knowledge of the absolute extreme edge of this duration risk. The text points this out at the very end of tip 3. Zero coupon equals highest duration. Memorize that phrase.
Yes, burn it into your brain.
But again, let's explain why it has the highest duration. What exactly is a zero coupon bond, and why is it so sensitive?
Well, a standard bond pays you a coupon, which is just a small interest payment, every 6 months until it matures, at which point you get your principal back.
Okay.
Those intermediate interest payments are crucial because they shorten the average time you have to wait to receive the bond's total cash flow. They actually pull the effective duration closer to the present.
But a zero coupon bond pays you absolutely nothing along the way. Zero coupons.
Right. You buy it at a steep discount today, and you wait 10, 20, or 30 years to receive a single lump sum payment at maturity.
Because there are no intermediate payments to act as a buffer, 100% of the bond's cash flow is locked up at the absolute furthest point on the timeline.
Exactly. Mathematically, its duration is exactly equal to its literal maturity. A 10-year zero-coupon bond has a full duration of 10 years. It is sitting on the very last atom of the edge of our seesaw.
Therefore, it is hypersensitive to any shift in interest rates. If rates go up, a zero-coupon bond will suffer the most severe, brutal price destruction in the entire fixed income market.
If a scenario question asks which bond will fluctuate the most in price, or which bond is the most dangerous in a rising rate environment, you scan the answers for the zero-coupon bond. That is the bullseye.
Here's where it gets really interesting. Combining the price-yield seesaw with the mechanics of duration risk gives you the complete picture of how individual bonds behave.
Right.
This is the foundation required to understand how active bond traders actually make money, which leads us to the concept of the bond life cycle.
This is a fascinating strategy outlined in the cheat sheet under key concepts. It is called riding the curve.
Riding the curve. The text defines it as buy longer bonds and sell before maturity as yield falls, and it adds a crucial caveat. Works in normal curve bond appreciates as it rolls down toward maturity.
Let's trace the logic here, step by step, using the mechanical rules we just established.
Okay.
The strategy explicitly requires a normal curve. As we know, a normal curve is upward sloping. Short-term yields are low, and long-term yields are high due to the term premium.
Right. So imagine a normal environment where a 30-year bond yields 4%. Well, a 5-year bond only yields 2%.
You execute the strategy by buying the 30-year bond, locking in that 4% yield. Now, you hold it for 25 years. You collect the high interest payments the whole time.
Okay, so after 25 years, that bond only has 5 years left until its final maturity date. It is no longer a 30-year bond in practice. It is physically a 5-year bond.
And because the curve is normal and upward sloping, the market dictates that a 5-year bond should only yield 2%.
Oh. So over that 25-year holding period, the yield of your specific bond has been forced to gradually fall from its original 4% down to 2% to match the shape of the curve.
Yes, and here is where the seesaw rule triggers the trapdoor of profitability. We know that rates fall equals prices rise. Because the yield of your bond fell from 4% to 2% as it aged, the capital price of your bond must have risen significantly.
That is the life cycle in action. As the text states, the bond depreciates as it rolls down toward maturity. You ride the physical shape of the curve to profit.
Exactly. You get to collect the high interest payments for years, and then you get to sell the bond on the open market for a massive capital gain because its yield dropped as it became a shorter duration instrument.
It is an elegant strategy. It's like gravity working in your favor. But it is entirely dependent on the curve being normal.
Entirely.
If the curve is inverted and short-term rates are higher than long-term rates, riding the curve will completely destroy your portfolio. As the bond ages and becomes a short-term bond, its yield would rise, meaning its price would collapse.
Understanding how these rules dictate the flow of capital is vital, but the Series 65 exam doesn't just test bonds in isolation. It tests your ability to see the massive ripple effects that interest rates have across the entire financial ecosystem.
Which brings us to the two incredibly dense critical boxes on our cheat sheet labeled When Rates Move.
These boxes are gold.
This is where we connect the fixed income world to the elegant currency markets. The exam writers absolutely love testing these cross-asset relationships. We need to dissect exactly why these specific asset classes react the way they do, so you aren't just relying on rote memorization.
Let's do it.
Let's look at the first scenario. Rates rise. The Fed is hiking the overnight rate. The cheat sheet gives 4 distinct market reactions. We already know the first 2. Bond prices fall, and longer duration loses more. Our seesaw analogy covers that perfectly.
Right.
But the third reaction jumps into the stock market. Growth stocks underperform. Utilities and REITs hurt. Let's break this down. Why do growth stocks specifically suffer when interest rates go up?
Well, if I think about a growth stock, say a massive innovative tech company, they usually aren't paying big dividends or showing massive profits today. Their entire valuation is based on the promise of massive profits 10 or 15 years in the future.
Okay, so it's all about the future.
Yes. That deferred promise is the entire key to their vulnerability. To price a stock, institutional investors use what is called a discounted cash flow model.
Discounted cash flow.
Right. They take all the estimated future profits of a company and discount them back to figure out what those future dollars are worth today. The interest rate is the core mechanism of that discount.
Got it.
If the current risk-free interest rate, like a government bond, is 0%, then a dollar earned 10 years from now is extremely valuable today. There is no penalty for waiting. Growth stocks soar in a zero interest rate environment.
But if the Fed hikes rates to 5%, suddenly I can get a guaranteed 5% return right now just by holding a boring treasury bond.
Exactly. Which means that tech companies' promise of a dollar 10 years from now suddenly looks much less attractive. Why would I take the massive risk on a startup's future earnings when I can get a guaranteed high yield today?
I mean, you wouldn't. When rates rise, the mathematical penalty for waiting for future cash flows becomes severe. The future earnings are discounted much more aggressively, which instantly collapses the current valuation of the growth stock.
That is why the cheat sheet explicitly states growth stocks underperform when rates rise. The math simply turns against them.
Okay, that makes perfect sense for growth stocks.
Yeah.
But the text also groups utilities and REITs real estate investment trusts into their hurt category.
Yes, it does.
These are incredibly different assets than high-flying tech companies. Utilities are boring power plants, and REITs are physical buildings. Why do they suffer when rates rise?
Utilities and REITs share a common structural weakness in a rising rate environment. They are incredibly capital intensive.
Capital intensive.
Right. It takes billions of dollars to build a new power grid or construct a portfolio of commercial skyscrapers. To fund these massive projects, utilities and REITs carry enormous amounts of debt. Yes. When interest rates rise, the cost of servicing that debt or refinancing old debt skyrockets. Their profit margins are severely squeezed by higher interest expenses.
But there is a second reason too, isn't there? The cheat sheet categorizes them this way because of how investors view them. Utilities and REITs are often treated as bond proxies.
Yes, that is the crucial behavioral element. Because utilities and REITs typically have stable, regulated cash flows, they pay out large, consistent dividends.
So they act like bonds.
Exactly. Many conservative investors buy them specifically for that dividend yield, treating them almost exactly like bonds. If a utility stock pays a 4% dividend, it looks like a great investment when government bonds are only yielding 1%.
But if the Fed hikes rates and suddenly a risk-free government bond is yielding 5%, why would an investor hold a risky utility stock for a 4% dividend?
They wouldn't. The investors dump the utility stocks and the REITs, and they move their money into the safer, higher-yielding government bonds. The massive sell-off tanks the stock price.
So to summarize the logic, when rates rise, Growth stocks die because their future earnings are discounted, and utilities and REITs die because their debt costs explode, and their dividends are no longer competitive with risk-free bonds.
That is the exact mechanical breakdown. If the test asks you what equities to sell when the Fed is aggressively tightening, you sell growth, utilities, and REITs.
The fourth and final reaction in the rates rise box brings in the currency market. It says, dollar strengthens.
This is a big one.
Let's dedicate some time to this because the mechanics of foreign exchange can be tricky. Why does the U.S. dollar get stronger when the Federal Reserve hikes domestic interest rates?
It all comes down to global capital flows chasing yield. Capital is agnostic. It flows to wherever it is treated best.
Okay, give me an example.
Imagine a massive pension fund based in Germany. They hold billions of euros. They're looking at the global landscape for safe returns. The European Central Bank has kept rates low, so German government bonds are only yielding 1%. Meanwhile, the U.S. Federal Reserve has aggressively hiked rates, pushing the yield on U.S. Treasuries up to 5%. The German pension fund manager looks at that spread and says, I need to buy U.S. Treasuries to get that 5% yield.
But they can't buy U.S. Treasuries with euros.
Precisely. They have to go into the foreign exchange market. They must sell their euros and buy U.S. dollars. When hundreds of global institutions are executing this same trade, selling their local currencies to buy dollars so they can access high-yielding U.S. bonds, it creates massive global demand for the U.S. dollar.
Basic economics dictates that when demand for something surges, its value goes up. The influx of foreign capital physically bids up the value of the dollar against other currencies. The dollar strengthens.
This is a vital connection to make. Rising interest rates act like a magnet, pulling foreign capital across borders, which structurally strengthens the domestic currency.
Okay, we have thoroughly mapped out the disaster scenario of rising rates. Let's look at the mirror image on the cheat sheet. The rates fall box.
The exact opposite.
If the Fed slashes rates, the reactions are exactly inverted. Number 1, bond prices rise because of the seesaw. Number 2, longer duration gains more because the long lever arm swings violently upward.
Right.
Number 3, growth stocks outperform. Utilities and REITs benefit. The math on the discounted cash flow model reverses, making future earnings incredibly valuable again, while utilities and REITs see their debt costs drop and their dividends suddenly look attractive compared to low-yielding bonds.
Exactly.
And number 4, dollar weakens.
The global capital flow reverses. If the Fed cuts rates to zero, U.S. bonds are no longer attractive. That German pension fund sells its U.S. bonds, converts the dollars back into euros, and takes its money home. The mass selling of the dollar causes it to weaken.
You have to commit these interconnected systems to memory. The exam is not going to ask you an isolated vocabulary question.
Never.
They're going to present a complex scenario that tests your ability to trace the logic from the Fed's initial action through the yield curve down to the specific impact on a client's diversified portfolio.
Which is the perfect transition to the ultimate test of our framework.
We are going to run a mock scenario right now. I'm going to address you directly again, the listener. Visualize yourself in the testing center. The room is quiet, the lights are bright, the clock is ticking down in the corner of your monitor. You click Next, and this multi-layered question appears on the screen. Listen very carefully to the specific terminology used.
Ready.
The question states, the Federal Reserve has been engaging in aggressive tightening by repeatedly hiking the Fed funds rate. The 10-year minus 2-year Treasury yield spread has just turned negative.
Let's freeze the scenario right there. The exam is attempting to overwhelm you with data points. We need to calmly isolate the variables and apply our cheat sheet logic.
Okay, where do we start?
The first implicit question you must answer in your head is, what shape is the yield curve and what economic phase is it predicting?
I am scanning my mental model. The scenario gives us a very specific data point. The 10-year minus 2-year Treasury yield spread has just turned negative.
Yep.
If I look down at the key concepts table on our material, it explicitly defines the yield spread as the 10-year minus 2-year Treasury yield difference. It then provides the decoder ring. Positive equals normal. Negative equals inverted. Narrowing towards zero equals flattening.
So apply the clue.
The scenario states the spread is negative. By strict definition, the curve is inverted. Short-term rates are currently higher than long-term rates.
That is a correct diagnostic step. You use the mathematical definition of the spread to identify the shape. Now we look at the second clue in the prompt to confirm our diagnosis. Aggressive tightening by repeatedly hiking the Fed funds rate. Does that align with an inverted curve?
Absolutely. Under the inverted section of the cheat sheet, it explicitly lists the Fed policy as aggressive tightening. We have a double confirmation. The shape is inverted, driven by the Fed hiking short rates. And because we know it is inverted, exam tip number 1 immediately provides the economic prediction. Inverted equals recession signal, most reliable leading indicator. The answer to the first part of the puzzle is that the curve is inverted, and it is warning us of an impending recession.
You have flawlessly diagnosed the macro environment. But the exam won't stop there. Now they twist the knife to test your portfolio management skills.
Oh, here we go.
Question 2. Based on this specific interest rate environment where the Fed is actively and aggressively hiking rates, what advice should you give to a client who is holding a 10-year zero-coupon bond and an equity portfolio heavily weighted in REITs and growth stocks?
Okay, this is where the cascading logic is critical. We know the environment. Rates are rising fast. We must evaluate each asset individually against that reality.
Let's deal with the zero-coupon bond first.
Step 1. We consult the rules on duration risk. We know that zero coupon equals highest duration. Because it pays no interest along the way, all of its cash flow is locked at the end of the 10 years. It is sitting on the extreme furthest edge of the duration seesaw.
Right. And step 2.
We consult the golden rule of the price-yield inverse. Rates rise equals prices fall.
Combine those two immutable laws of physics. What is the outcome for the client's bond?
It is a bloodbath. Because the Fed is violently hiking rates, the rate side of the seesaw is flying upward, meaning the price side must slam into the ground.
Yep.
Because the client is holding a zero-coupon bond, they are sitting on the very edge of that slamming seesaw. Their bond is going to suffer the most severe, devastating price drops possible in the fixed income market. As an advisor, you must tell them to sell that zero-coupon bond immediately before the rate hikes destroy the rest of its capital value.
Spot-on analysis of the bond mechanics. Now we evaluate the equity side of the portfolio. The client is heavy in REITs and growth stocks.
For this, we apply the logic from the when rates move rapid-fire boxes. We are locked into a rates rise scenario.
Let's start with growth.
First, the growth stocks. As rates rise, the discounted cash flow models heavily penalize the future earnings of those tech companies. The present value of the stock collapses. The cheat sheet confirms. Growth stocks underperform.
And the REITs.
Second, the REITs. Real estate investment trusts are capital-intensive and carry massive debt. As the Fed hikes rates, their borrowing costs explode, crushing their profit margins and threatening their dividends. Furthermore, investors will dump them in favor of newly high-yielding, safe government bonds. The cheat sheet confirms. Utilities and REITs hurt.
So, synthesize all of that analysis into the final comprehensive answer for the multiple choice question.
The correct answer you select on the exam would be: the negative yield spread indicates an inverted yield curve, which signals an impending recession caused by the Fed's aggressive rate hikes. In this rising rate environment, the zero-coupon bond will suffer severe capital loss due to extreme duration risk. Furthermore, the equity portfolio is improperly positioned. REITs will be hurt by rising debt costs, and growth stocks will underperform as their future earnings are discounted. The client should restructure their entire portfolio.
If we connect this to the bigger picture, that is how you decode the matrix.
It really is like a matrix.
Look at how an incredibly isolated piece of data, the overnight lending rate between two commercial banks, creates a massive, inescapable ripple effect. It alters the shape of the yield curve, distorts the term premium, dictates the price of a 30-year bond, and ultimately crashes the share price of a tech startup and the value of a real estate trust.
It's crazy when you think about it.
It is a single, interconnected ecosystem governed by strict mathematical laws.
So what does this all mean? If you can trace that logic from start to finish, understanding the why at every single step, you aren't just going to pass the Series 65, you are going to be an incredibly competent financial professional.
Absolutely.
Let's bring this all home. Let's do a final recap of the 3 absolute unbreakable pillars we pulled from this material. Number 1, the price-yield seesaw. Bond prices and yields always, without exception, move in opposite directions. When rates rise, prices fall. Picture the wooden seesaw.
Never forget the seesaw.
Number 2, the 1955 recession stat. An inverted curve where short-term yields are artificially pushed higher than long-term yields is the ultimate recession predictor. The stampede into long bonds is the physical footprint of the market bracing for impact. It is always the answer for recession prediction.
Always.
Number 3, duration risk extremes. The longer you wait for your money, the more violently the bond's price swings when rates change. And the zero-coupon bond, which pays nothing until the very end, is the undisputed king of duration risk.
If you build your exam strategy on those 3 pillars, the test writers cannot trick you.
They just can't. The yield curve isn't just theory. It is a practical map of human expectations and central bank mechanics.
And before we close this deep dive, I want to leave you with one final philosophical question to ponder, based purely on the mechanics we've explored today.
Ooh, okay. Lay it on us.
We know an inverted curve is the market actively bracing for a recession. We know a normal curve is the market confidently investing in growth.
Right.
But think back to the flat curve, the horizontal line that acts as the transitional pendulum. The text defines it as a moment when the market is deeply uncertain about the direction of rates.
The moment of transition.
Right. If the entire global financial system relies on the yield curve for signals, but the yield curve itself gets stuck in a flat, uncertain phase for an extended period of time, what happens to the psychology of the market? Who is actually leading whom? Does the flat curve merely reflect the uncertainty of the investors, or do the investors become paralyzed with uncertainty because the curve isn't giving them a clear instruction?
That's a paradox.
When the ultimate diagnostic tool stops providing a reading, how does an interconnected system of trillions of dollars correct itself without tearing itself apart?
A diagnostic loop of mass paralysis. That is a fascinating, slightly terrifying thought to leave them with. It really highlights how much of this mathematical system is actually driven by raw human psychology.
It really is.
Well, listener, don't let that macroeconomic uncertainty paralyze your own studying. Take a deep breath. Trust the mechanical frameworks we built today. Visualize the seesaw. Visualize the jump rope. Visualize the discounted cash flows. You have the map. You understand the rules of the ecosystem, and you are going to absolutely crush the Series 65 exam. Thanks for joining us on this deep dive. We will catch you next time.